This conference will now be recorded.
Hi, this is Ron Welch with Welch Financial Planning. Thank you for joining us for our third quarter 2019 quarterly investment update. Hopefully I'll be taking about 20 minutes of your time and go through some important investment information and analysis that we've done. If you have any questions that pop up, feel free to give me a call afterwards and I'll answer those in detail as best I can. So with that, I do want to open up with a couple comments from our economic update that we did on Tuesday. We need to create the backdrop of that to understand where we are investment-wise. So real quick, the economy is okay, but it is slowing. We're at about a 3% growth rate and feel that that's going to drop down to a 2% growth rate moving forward. Do anticipate that the Feds will drop rates by 0.25% in July. There is some, there's certainly some pressure for them to drop further, but they may not drop more than that just because they're running out of ammunition for future crisis. So if we do have a large economic downturn, the Feds are running out of tools or bullets, if you will, to combat that. So they might be a little stingy on their rate reductions. Europe is slowing. They have started slowing last quarter, and hopefully they will stabilize. Some of this is trade war and tariffs related. Corporate America has stopped making investments for a little bit. We really need them to be making capital improvements to improve our productivity per worker and to just generally be spending money. As you can imagine, if you're a corporate CEO or you're responsible for a division, before you make $1 billion investment in a new plant or a new piece of equipment, you really would like the trade situation to be stabilized, to be tariffs, have a long-term view on what tariffs are going to look like moving forward. So we are seeing corporate America investment-wise kind of sitting on the sidelines a little bit, kind of waiting till this all works out. So let's go ahead and get started with our information from here. Obviously, you probably know that the S&P 500 continues to escalate significantly in 2018 after a little bit of a drop in 2017. This is a 20% drop, by the way. So what you felt was real at the end of 2017, and then it quickly climbed back up. And we just hit an all-time high a couple of weeks ago as we're trending sideways over the last week or so. So yes, the S&P 500 has been on a steady uphill climb since 2008. Now, what that does is it does create a view that stocks are getting a little bit expensive. And here's the forward PE ratios going back from 1994, and we see everybody remembers what happened in 2000, 2001, 2, and 3 as the stock market went back down, and then obviously in 2008 felt that the earnings per price ratio was very low in 2008, which makes sense because it was actually negative at some point. So here's the 25-year average of PE ratio is 16.19, and that's basically saying that when a company, let's take IBM. So when IBM earns $1, we are willing to pay $16.19 for that stock. Okay. And so when we come out here to 16.74, we're starting to pay a little bit more for companies than we have in the past. And actually the ratio today that I just looked at before hopping on here is about 17.1. So really, as we are today, we're a little bit higher there. Okay, so we see the correction that took place here at the end of 2017, brought the PE ratio back into line, and we've hopped back up, but it is continuing to climb. So when you're above the 25-year average, the way to get back to the average is one of two ways. One, either the price of stocks comes down, which is not one of the favorite ways to work that out, or number two, corporate earnings end up being higher than we anticipated. Because this is all, we're always trying to look at the broken crystal ball and think of where the economy is going to be moving forward. We don't have that. We don't know that. So we may have some surprises on earnings being better than we thought they would. Okay. So in general, I think it's fair to make the comment that the stock market is a little bit overpriced as we know today. Over the next couple of weeks, earnings for second quarter, meaning the period that ended June 30th, will start coming in, and we'll see if earnings will support this higher stock level or not. Corporate profits for the first quarter of 2019, this will always lag by a quarter. Second quarter 2019 will be currently reported in the next couple of weeks. So we just finished a wonderful quarter of $38 a share. We are expecting that second quarter 2019 will be higher than that, and we expect the quarters to go fairly well. As a whole, the analysts, meaning basically everybody that tracks the stock market and gets paid to write values in the stock market, they're estimating a 15% growth in earnings per share over the next year. Dr. Kelly from JP Morgan, conference call with him yesterday, he basically said no way. So there is some split in there with the general analyst pool is saying versus one of the best economists out there. So we are kind of hedging that a little bit. 15% feels awful frothy to me. Over here on the right, this is somewhat of a repeat of where we were on Tuesday, but I think it bears some repeating. One of the things here is the net earning revisions, and this is when a company comes out, like Netflix did yesterday, and Netflix said, hey, yes, our subscriptions are falling. We don't think we have the right content on Netflix right now. And so we expect that our earnings in third quarter will be lower than earnings in second quarter. Okay, so when a company comes out and says that would, that's what's happening here. Well, other companies are coming out and saying, no, our earnings are going to be better than what we originally thought, and they're revising up. So you can certainly see as companies are revising down, that kind of correlates to a recession. Okay, and we're seeing that pretty clearly in these two spots here. So revisions over the last couple of quarters have been pretty mild, meaning people have done a decent job of forecasting and their actuals are hitting forecasts. So hopefully that will continue, and that's nice to happen. S&P profit margins are continuing to be strong. 11% is really pretty high over historical. What's happening there, for the most part, is price increases are coming through okay. The cost of labor continues to be a very slow growth there. Unemployment is coming down to record lows, but people are not getting big raises yet. And so corporate are able to hold their labor costs steady, and then the price of oil has declined over the last 18 months or so quite a bit, and that helps with their profit margins. So still a little bit high historically, so that I always feel that things regress to the mean a little bit, and so I'm not sure that these margins are really sustainable moving forward. So from here, we're going to revisit the PE ratio again, but in some additional detail. So again, here's the current PE, which is price divided by earnings. Again, so this is when a company earns $1, how much are we willing to pay for? Okay. Up here, the top part is the actual for today, and here's the historical average over 20 years. So we're starting to see that in the large cap companies or the big companies, the current ratio is above the 20-year average. And so when that occurs, you're kind of saying that that's a little bit expensive. Okay, why are we willing to pay more than we have in the past? And the answer would be because we think earnings will increase and will justify that price, but we just don't know that's true. We got to wait till the quarter unfolds to happen on that. Down here are the same numbers, but on a percentage basis. So we're currently paying 103% of typical prices for stock for large cap value. So if we kind of look over here, is that the small cap growth, meaning the smaller companies that would be geared towards growing, we're paying 125% over the historical average. So that looks really expensive. So the only thing on this chart that looks like a good opportunity or reasonable opportunity is small cap value. We're currently paying less for small cap value than we have in the past. So that might be something as it regresses to the mean. As this 14 closes in on 16, the historical average, you'll pick up some gains in that area. So that's one of the areas that we're looking at. Keep an eye on that and find some opportunities. Page 14, this is one of the many slides that we have in here, just to make sure that we maintain perspective on where we're at. So this is affectionately known as the measles chart. We do this every quarter. And quickly, the bar here, the solid bar, is where the stock market ended at the end of the year. Okay, and so we see obviously, 2001, 2, and 3, the 3 consecutive down years, and then everybody on this call would certainly remember 2008, down 38. Okay, the dot, or the measle, is the lowest point of the market that year, or from top to bottom. So when we look at 2017, the stock market was actually up about 13% at the beginning of September. And then from September 3rd or 4th was the peak. It dropped 20% from September 4th to December 24th. And that drop was a 20% down. And then the year ended at a total of 6% down for the year. So this year we started out with a big dip of 7%. That's actually took place in May, and we are up 17 and now 18% year to date. The market continued to move up a little bit during July. So this is as of June 30th, 2019. So volatility is real. Volatility has always happened. When you hear somebody say, well, the market seems more volatile now than it has been, that's not true. And this chart will tell you that. A down 7 is actually, right on pace, maybe even a little below average. An up 17 is a good year, but there's a lot of periods. You certainly don't see a cluster around like an 8%. A 6 or 7% would be the average during this time period, but how many of those numbers do you see? It's either up significantly or just a little bit. That's the measles chart. From here, I'm going to look at the yield curve. My clients certainly understand that we are not bond friendly in here right now. We don't enjoy bonds. We think they're kind of dangerous. And this is the chart that really drives this discussion a little bit. So here's December 31st, 2013. And here is today. And so you can see that the curve is significantly sloping up during this time frame to where, if you wanted to borrow money for a year, it was actually fairly inexpensive. Pay very little interest during that year. Okay. And now we see the yield curve today where, you're going to pay, some interest, or you're going to be able to collect some interest on things 1 year out. But the thing that's significant or material to me is that you can lend money to the federal government for 10 years. You're loaning money to the federal government for 10 years, and you're going to get 2% return on it every year for 10 years. You need to understand that inflation is also at 2%. So you're basically gaining when you invest in the treasuries, you're gaining no ground over a 10-year period. And you will lose ground if inflation goes over 2%. Now, we don't really see inflation happening anytime soon, but at who knows, 2, 3, 4 years from now, you just don't have vision of what's going to happen. What's interesting to me is this chart here, and I'm going to stick mostly to the left, and that's the global central bank bond purchases. So as people would remember, back here, this is where governments are actually buying their own bonds. Okay, so the federal government, which is not on this chart, but our federal government, the Treasury Department was out buying treasuries significantly in 2009, 10, and 11. Okay, and this chart shows that the Bank of Japan and Europe basically have been buying their own bonds during this time period, but everybody is selling them at this point, which is kind of flooding the market with bonds. Okay, so there's now more bonds being available out on the market. What's interesting to me is that interest rates are not climbing. People are out happy to buy these bonds from the federal governments across the world at low interest rates. And that's just kind of a signal for safety. They know that The US is going to pay that obligation. They know that the Germans are going to pay that obligation. And as we're going to talk about in a minute, the German 10-year bond is actually a negative return today. They're going to give you a negative interest rate over a 10-year period when you look at it against inflation. And people are still buying those bonds. So there's still a lot of fear out there. There's no doubt about that. Now, some people have to buy bonds. You know, certainly insurance companies are required to buy bonds to pull risk out of their portfolio. So when your hailstorm wipes out your roof, the insurance companies need to meet those obligations. So a lot of their portfolio is in very conservative type investments, and that does drive some of the bonds. Certainly pensions need to buy bonds, endowment funds need to buy bonds, and so that demand is picking up. And then obviously there's a lot of people that just don't like the stock market, and they'll continue to buy bonds even though they're breaking even on that. So rate changes across the developed market central banks. So those are countries, you know, think of that as countries with stable economies. Everybody has started kind of hiking their rates a little bit. Very few cuts are going on. So the US, you know, if they make the cut in July, that will be kind of a bigger number here. But we can see that the economy, you know, that interest rates, the increase in interest rates is slowing as it turns this point here. Okay, so fewer hikes are taking place in 2019. That's going to be an indicator that the federal governments feel like the economy is softening. So from here, the other big piece, or another big piece that we look at is the value of the dollar. And we see that you know, the dollar was at a high during the 2000s, and generally the dollar will strengthen in times of big uncertainty. So people like to retreat into the dollar for safety, and they're doing this during the big market down. And then we can see that the dollar weakened as our economy weakened, and then has kind of strengthened back up. So the forecasts are that the dollar will continue or will from here to decline or weaken. And that doesn't mean tomorrow or next week or next month, but you know, kind of over the next 4 or 5 years, we should see the dollar weaken. And the drivers of that, there's really 4 reasons why that could happen. One is our economy is slowing. So anytime our economy slows, that weakens the dollar because there's just, you know, fewer people are buying our goods, and you just don't need as many dollars when our economy weakens. Secondly is there is an increase in the trade deficit. So you're seeing our trade deficit has kind of moved sideways. The tariffs, as they continue to be in place, that will increase our trade deficit, which is a little bit counterintuitive. But as we put in tariffs, so do other countries. And so it ends up that we're going to end up buying more things from foreign countries than we do export. We'll see that happening moving forward if the tariffs stay in place. And then the other one is the developed markets interest rate differentials. And as I mentioned earlier, the 10-year Bund, which is the German bond, has basically got a 0 return over a 10-year period, where the US is paying 2%. And I'm not saying the 2% is something you need to jump on, but as we are driving the price of the 10-year Treasury down through reduced rates of the Fed, it's less incentive for foreign dollars to come in to be converted into US dollars to buy US bonds at that time. So that interest rate differential will narrow, and that will decrease the value of the dollar. The other one that is a little bit interesting is that the Treasury Department is now publicly saying, and you'll see those articles in the last couple of days if you look at that, but the Treasury Department is getting behind the effort of trying to reduce the value of the dollar. That's not the Fed. The Fed's mission is to control inflation and work on full employment, and work on growth. So their mandate is to keep growth at 3%, GDP growth at 3% year over year, and inflation at 2% year over year. And so that's the Fed's mission. The Treasury Department handles the cash flow for the federal government, but also can do some currency, and I'm just going to say manipulation. And all countries do that for sure. But now the Treasury, it looks like they're going to try to aggressively lower the dollar because it would help our economy. Now, you don't get to do that in a vacuum. As we start taking methods to reduce and lower our currency, countries will respond to that and try and lower theirs. So it's just this gigantic battlefield of every country out there trying to get their currency set. So it's nothing new. It's been going on forever, but it is a little bit different for the US Treasury to come out and work towards a weaker dollar. From here, page 41, a little bit of a complex chart here, but I think it is worth talking about a little bit. So what it is, the sources of global equity returns broken down into 4 different categories. So you're going to see 4 different colors in here. One is the total return, okay, but the growth in the stock due to earnings, meaning a company earned $1 a share and then made $1.10 a share, that would increase the stock price, and we'd see that represented here. Next would be dividends, as in a company pays out a dividend. I mean, the higher the dividend, the more you're willing to pay that stock because you want that future cash flow. So that would certainly help it. And then currency. This is actually emerging markets. And then currency fluctuation. So in this case, the over 2004 to 2018, the dollar weakened during this time period. And so the value of the emerging market coming back in here reduced the return. So you add these things up and they all average out to 8.3%. Okay. The one category that I didn't get to talk to, but look at on the US, this gray area here is multiples. This is the PE ratio. Okay, so the stock prices in this situation declined because the PE ratio declined, meaning we weren't willing to pay as much on a multiple of that dollar. So this is back to IBM earns $1. Currently, or if IBM or any corporation earns $1, we're willing to pay $17 for that stock. In this scenario, when that company made $1, we weren't willing to pay $17 for that stock. Maybe we were only willing to pay $15 for that stock. Okay, but over this time period, that really negates out. So the story here that we're really getting to is that in 2018, this is the PE ratio really declining. That we're basically saying that corporation that bought, that the corporation that made $1, we were not willing to pay for that multiple, and the PE ratio dropped significantly. And if you go back to that chart that we looked at, the 3rd slide in, you'll see that the PE ratio declined significantly in 2018. We just weren't willing to pay for that dollar of earnings like we are today. Okay, and the core and the important part that we're really looking at and want to illustrate in this is sentiment. This is when all of us get together and be like, nope, I'm not paying that stock price on $1 earnings. We're not going to pay 17. We're only going to pay 14 or 15. Okay, and this is just us collectively as stockholders getting together and say, nope, we're just not going to do it. It's our sentiment. We're not basing it on anything logical, and we know that because the earnings in 2018 all look really good. We've got dividends that look good in there, and currency coming in for Japan, in that scenario. So 2018, corporate America, or really the world as a whole, did very well when it came to earnings and when it came to dividends. We just weren't willing to pay for it. And if you kind of look at it, 2019, emerging markets and Japan, both their earnings have declined. Dividends stayed the same. Okay, actually European dividends went up a little bit. If you look at that, for some reason, we've decided that we're going to pay more for that dollar of earnings than we did in 2018. We were fearful of the future of that dollar, and for some reason in 2019, we've decided that it's okay to do that. And that's just us collectively having sentiment in there. Okay, if you look at 19, this has not been a great year for emerging markets in Japan. Their earnings growth has really not done well. Okay, it is slowing. Okay, and now it's all about multiples. So the summary of the importance of this slide is to show the short-term impact of you and I just getting up and being optimistic, or you and I getting up and just being pessimistic as a whole. It's causing huge swings in the market between 18 and 19. But then when you look at it over time, the multiples even out and become a real small portion of the value of the stock market. So again, this is the long-term view support. So another spot that we feel that value or opportunities exist are on international equities. And if you've been following this quarterly presentation for a couple of years, it's been a lot of the same discussion. And if you look at it, from 1997, international markets have not been valued, at the same level of the U.S., but they're certainly heavily correlated. Okay, and they did merge, in 2008 briefly, to where we were paying the same for international stock as we were for U.S. And then down they both go basically 100% correlated, and maintained 100% correlation until about 2012 they decoupled. And the U.S. market went from went up to a multiples of PE of 16.7. Well, international just moved sideways basically, and the PE ratio was 13. So that means that when the international company earns $1, we'll pay $13.20 for that stock. When a U.S. company earns $1, we'll pay $16.7 for that stock. Okay, this decoupling provides us an opportunity of what's going on. Okay, and if we look up here, the PE ratio of 16.7, the international of 13.2, that's coming from these two numbers here. But the 20-year average is 15.7, and then international is 14. Okay, so we're still not purchasing international stocks. We're not valuing the same, even though they're earning $1. So we feel that there's some opportunity again on the international side, and the portfolios that we have generally reflect that, depending on people's risk tolerance. So the two pieces that we feel that there's some opportunity is international and then small cap value, which is about the second or third slide that we talked about. From here, this is called the Quilt chart, or I've heard people start calling it the Skittles chart, because Skittles marketing department is doing better than the Quilt marketing department at this point. But year to date, a well-diversified portfolio should return about 12.3%. So each color on here represents a certain segment of the market. Here is REITs, which is real estate investment trusts. So real estate leads the year to date. Large cap, that's our domestic market. Large companies, also represented as the S&P 500. Right behind it is the small cap companies. Then international is kicking in at 14.5% developed markets, so that's also doing well. Emerging markets is also on the positive side, up 10% year to date. That's fun to have. Junk bonds makes an appearance at 9.5. We don't feel that's sustainable. We are not getting in high yield. And then fixed income and commodities and cash. So if you were allocated into these positions, you should be averaging out about 12.3% in your portfolio. Okay. So with that, it is kind of interesting when you look at the returns between 2004 and 2018. The second best performing sector of the market there is emerging markets, and it's in 5th place for 2019, and actually was in last place in 2018. So just because something has performed poorly in the last couple of years, look at what it's done over the last 15 years. So let's not abandon that, because it will be back at a certain point. Slide 63, this is a little bit of the big perspective. I use this a lot with clients, and I talk about this every quarter that we get together. And to me, it supports a little bit of the bonds are trouble over a long time period. Okay, and so the green bar here is the stock market. And so the best 1 year return in the stock market is up 47%. The worst 1 year return in the stock market is down 39%. This is from 1950 to 2018. So that's 2008. We know what that is. Bonds, on the other hand, have a significantly less downside on a per year basis. So the worst time period of bonds down 8% is only 8% relative to the market of 39, and the best 1 year return of bonds is 43. So in a 1 year, 1 year in time, really the stock market and the bond market has had, similar upside, but a dissimilar downside. But then when we look at it over then moving from a 1 year time period to a 5 year time period, the best 5 year time period for the stock market is up 28. The worst 5 year time period is 2003. It holds 2008 in it. That's the big factor there. But bonds down 2 and up 23. Okay, so now you can start seeing this trend of, as we add time period here, going from 1, 5, 10, and 20 years, you see stocks kind of drop down from 47 to 28 to 19 and then kind of move sideways. I mean, it's kind of like a pretty mellow ski ramp. But bonds keep declining down, going from 16 to 12. That's a 25% down point between there. But the other thing is that the downside of bonds really doesn't move up that much. Stocks are moving up from 39 to 6. Bonds are moving from -8 to +1. Okay, so if you look at it, all the magic happens as a stock owner, all the magic happens between 10 and 20 years. Okay, and then you see it go from 19% return to a 17, not much of a drop, but you see that -1 turned into a +6. That's a big swing. While the bond bottom still stays the same from 1% to 1%, and the bond goes from 16 to 12. So 10 and 20 years. So when somebody asks me what the stock market is going to do this year, I don't really care. It's not important to me, and it shouldn't be important to you. It's what happens to the stocks over the long term. So from there, here's a little bit of a different picture. This one is interesting to me. Here is as the data is of June 30th on here. Well, that's when the top was updated. The bottom part of this chart, which is really what we want to look at, is this includes 2018. It does not have the 18% up in the 19. So I think it's a little bit misleading, but they don't have the full years. But anyways, the best returning asset class over the last 20 years has been real estate. Shouldn't really surprise anybody. Real estate's been making a lot of moves in there. We feel that the best way to invest in real estate is directly through rental property, not through partnerships, not through REITs. I understand REITs are here, but the REITs that you and I can buy are not the REITs that are represented here. So if you wanted to get into real estate, come into the office, we'll sit and talk about it, and buying a single family home in Lafayette or something like that would be a good option. Next is gold. This is surprising to me. This is really supported by 2008 as the economy tanked. Gold really went up. Oil, again, surprising. The S&P 500 is averaged 5.6% over the last 20 years. So it's been a very tough time for the S&P 500. And then this is partial bonds. 60% stocks, 40% bonds, 40% stocks, 60% bonds, and then bonds. And so we see the returns decline to homes, inflation, but here we go. Here's the average investor. So the average investor has returned 2% over the last 20 years, while the stock market has gone up 5.6%. So you're really struggling. The individual investor just struggles to hit the market. And fear, getting in and out of the market, timing the market, listening to the news are all detriments. And so hopefully your financial advisor is out there getting you a better return than that. So people ask me if I outperform the S&P 500. I say I don't have to. I just need to outperform you. And if you're happy with 1.9, have at it. But if you want closer to the S&P 500, get a financial advisor in place. So with that, that does bring us to a conclusion. I went for 35 minutes, a little bit longer than what I had hoped for. But if you have any questions, feel free to call. Quick summary, our economy is slowing. What I mean by that, it's going from like 55 miles an hour to 45 miles an hour. It is not going in reverse. That's not what I said. It is slowing though. The stock market is overpriced currently, not to like not to like, oh my gosh point of view, but hey, it's getting a little expensive out there. We do see some opportunities in international, and we see it in small cap value. So with that, I'm going to go ahead and close our presentation. Thank you very much for your time. Have a super day, and we'll talk to you soon.